Now let's get into this video. Let me know in the comment section below what your favorite options trading strategy is. In today's video, I want to talk about a very simple strategy that doesn't cost a lot of money, but can definitely give us some pretty big returns if we're utilizing this strategy on proper stocks. I actually entered this strategy today, and I'll show you that at the end of the video. So our goal from this strategy will be to profit from neutral stock price action. And so the ideal scenario here will be to find stocks that have neutral movement, that trade sideways, and that stay between a narrow price range. So in layman terms, we want to find stocks with very low volatility. We don't want high volatile stocks that have huge price swings. And so for the demo here, I'm going to use HWM. This is a stock I literally found today. Again, this is just an example of a trade. Please don't copy this exact trade. This is just an example. So here we are on this stock. Now, the first thing I would do when trying to set up this trade is first check if the stock has a dividend, and if it does, check the ex-dividend date. So if I go down here, I can see this does have a dividend right now. So what I like to use is Nasdaq.com. So I go over to the Nasdaq.com and I search up HWM. I take a look at its dividend history and I can see the ex-dividend date. So for the latest one, the ex-dividend date was April 1st, 2020. Doesn't look like there's been anything since. So it looks like I will be okay with this. And I'll talk about why you want to check the ex-dividend later. So I'll go back to Robinhood now, and I can go ahead and continue with this trade. So I'll go over to the options here for this stock. Now, this is going to be a three-part strategy involving 4 contracts. All contracts will have the same expiration date, and we're actually going to be using puts this time. I know that for all of my strategies, I've been showing you guys these strategies using calls. We need to start using puts for these strategies here because there are some key differences and some benefits to using one over the other. So I'm going to be using puts for this strategy here. And so the first thing that I'm going to want to do is I'm going to first determine what price I believe my stock will be at on expiration. So you can see the current expiration for these options is May 21st. So the first thing I'd want to do is try to determine what price I think this stock will be at on May 21st. Now let's think I believe this stock will be at around $32 on the expiration date of May 21st. So around $32. So what I'm going to want to do then is I'm going to want to sell 2 put options at that strike price. So since I think this stock will be at around $32 on expiration, I'm going to use this option at the 32 strike, and I'm going to sell 2 put options there. So I'm going to click on here, and this will only allow you to do 1 here, and I'll show you guys how you can change this to 2 when we're done with the trade here. So we're going to want to sell 2 of these. And so for selling 1 of these, we're going to receive 53 cents per share. Remember, each contract controls 100 shares. So we're going to receive about $53. And again, we're going to do 2. So we're actually going to receive about $106 for selling these 2 put options here. And so now what I want to do is I want to buy 2 put options. 1 put above this strike, 1 put below the strike. And something that's very important that I need to mention, strike prices should be equidistant. Now, here's what I mean by that. If I go ahead and go to buy now, again, I want to buy a put that's a strike price higher than the strike of the puts I just sold. So if I, for example, bought this put here, this is going to cost me 93 cents a share, $93 per contract. This is $1 away in terms of strike from the strike of the put that I sold, meaning that the put I buy below the strike of the put I sold should also be $1. So I'd have to buy this one now, which would cost me $28, right? Again, why? Because they need to be equidistant. This is $1 away from this one. This is $1 away from this one. If I had instead bought this put out here instead of this one, this would have been $2 away from that mid strike, the strike of the puts we're selling. So then I would have had to bought this one instead. So that's also $2. So again, strike prices should be equidistant. So now that we've got that set up, now we can come over here, and remember, we need to sell 2 puts, not just 1. So I can click on this drop down and click on custom here. And then I can change the number of contracts. So I want 2 contracts here. So as you can see, this is going to cost about $15 or so to enter this trade. It's what it's telling me right here. Now, here's the thing. My max risk is defined here. It's going to be the debit that I'm paying to enter this trade, which in this case, again, is going to be about $15, right? So your max risk is always defined. And as you can see, it's a very low cost of about $15. Our max profit is also defined, and we have a quick formula here to determine what that profit is, so you can kind of quickly come up with it. So to determine that, what you do is you go over to your strikes that you chose. We chose 33, 32, and 31. We take the highest strike, we subtract the mid strike, so 33 minus 32 is 1. Multiply that by 100, that's 100, and we subtract our cost, which is going to be $15. That's going to give us $85. So our max potential profit will be around $85. So we're risking $15 to potentially make $85 with this strategy. By the way, this is the long put butterfly spread. Okay, if you guys are wondering. So now we can go over to the options profit calculator. Let's actually take a look at what this looks like. So here we are in the options profit calculator. Under advanced, there is a butterfly link you can click on. And again, I already put HWM here, so I can click on get price here. It's been kind of slow today for some reason. So hopefully this fills up here very quickly. And so what we're going to do now is we're going to, again, pretty much enter the exact same trade we just wrote on Robinhood. So let's start with our mid strikes here, the puts that we're selling or writing. So we'll click on select option. Again, we had chosen May 21st as our expiration. Calls are on the left, puts are on the right. I've shown you how to do this with calls before. Now we're doing it with puts. So here's puts over here. And for this one, we sold the 32 strike. So I'll go right there. And again, 2 of them. So we're going to receive about $110 for that. But now we need to buy our lower wing. We need to buy our upper wing. So let's start with buying our lower wing. So the lower strike was 31, which is right here, same expiration, and puts are on the right, so right there. And then our upper wing, again, same expiration. This one we chose the 33 strike, and then puts are on the right. And then for the stock price range, I'll go from 27 to about 35. So let's calculate this. Let's see what this visually looks like. So as you can see, our entry cost, so for this one's a little bit different, $18. Net debit, that's how much we're paying to enter this trade. It's also going to be our max risk. That's the most you can lose here. Max return, $82. So again, we're risking $18 to potentially make about $82. And this is what it looks like. So as you can see, this is why we want to find a stock that has low volatility, that trades sideways with neutral movement, because we don't want the stock to go up. We don't want the stock to go down. We want it to kind of trade between this defined range. So as you can see, our max return is 82 at a price of 32 on expiration. So where does this $32 come from? That's the strike we chose for the puts that we're selling, right? That's why that's the first step that I like to start with, determining what price we think the stock will be at on expiration, and then selling puts with the strike as close to that price as possible, because that's what we want. That's the ideal situation. At that rate, we would get $82 or about a 456% return. Now, a couple of things, of course, you can always close this out before expiration, right? But of course, the closer you get to expiration, the higher your profit will be. But for example, on May 15th here, if the stock is between 33 and, about 30.67, you're still making some profit. And these are still some pretty big returns, right? 16%, 33, 44, 50% returns. So you can definitely close up before expiration. I know a lot of people like to do that. So this is what it would look like. Your break evens on expiration, 31.18, 32.82. So as long as the price is between these two ranges, you are making some money, but that's at expiration, right? As you can see at expiration, it's definitely a lot narrower than, again, if you go out a little bit before that. But anyways, a couple of things I do want to mention here. First of all is commissions. So on Robinhood, we're okay, does not have commission fees. But on other brokers that does have commission fees, those can definitely eat away at your profit because you are opening and closing 4 contracts here, right? So definitely make sure you're aware of that. Make sure that that's not eating way too much at your profit. So risk to reward, make sure you understand that. The other thing, of course, that's big here is risk of early assignment. So firstly, I recommend manually closing any trade you ever enter. And I'll put a link to a video in the description below where I show you guys how to exit any trade at all. Don't let your broker do it for you. I don't trust Robinhood doing it for me. I have seen some very rare cases where things can go very wrong. So I always recommend manually closing this, even if it's 1 minute before the expiration date ends. And the other thing, of course, is that anytime you sell an option, there is a probability of assignment. Early assignment, meaning that you get assigned way before the expiration date, is generally related to dividends. That's why the first thing that we did was we checked to see if it had a dividend, and then we checked the ex-dividend date. Why? Because again, early assignment is generally related to dividends. So if you want to avoid early assignment and having to deal with that, you can either A, just completely avoid selling options on that ex-dividend week so you don't have to, deal with that, or you need to close out 2 days prior to the ex-dividend date. So anyways, guys, this is the long put butterfly spread. Again, if you're using great stocks for this, implementing the strategy correctly, this can give you some pretty big returns. And again, it's very low cost. And so I did mention I actually entered one today, and I actually did that on AT&T. So I'll just show you that here very quickly. So as you can see, here's my AT&T one. So as you can see, 4 contracts, guys. It cost me $16, so I'm looking to potentially make a $34 profit if this all goes correctly, which would be a 213% return. This expires next week. So I will update you guys next week on how this trade goes for me. But anyways, if you have any questions, feel free to leave them in the comment section below. Check out the Discord link to it in the description below. Hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.